Hello, it's Kei from Tokyo. This is a part 5 of Ichimoku series, and on this video, I'll be talking about the wave theory and price observation theory with some recent chart examples. And this is going to be the last video for Ichimoku series. I might be uploading some more videos for catch up in the future, but officially this is going to be the last one. So if you're already interested in the topic, please press a good button and make sure to subscribe and hit the bell for my future Forex educational videos and live analysis. So let's get started right now. So on this video, first I will talk about the wave theory. Then I will show you how to combine time and wave theories together. And after that, I will introduce price observation theory. And finally, I will show you how to put everything together along with Ichimoku indicator. And I will explain it from some real chart examples in the end. Alright? So let's just start with the wave theory first. As for the price movement of the market, basically there are three patterns. First one is this. When you think about the market, the price simply either goes up or goes down. And of course there are some minor price actions within the continuous major trend, but basically when you look at the movement of the price, simply there are only two ways after all. It's either going up or going down. And this is one of the wave patterns, and this is called I wave, just like the letter I. On the other hand, when the price goes down and up, then it's called V wave, sorry. In Japanese, wave is called hado, H-A-D-O, So sometimes I usually call it hado, but anyways, there's V wave like this that appears on the market. And basically speaking, the market moves with three waves as one major move. If you add I wave and V wave together, it's going to be N wave, as you can see here. These are the examples of bull trend. So when it's bearish, it's going to be opposite. I wave will be like this, V wave will be like this, and N wave will be like this. And these are the typical three major wave formations in Ichimoku Kinko Hyo. And there are some other variations like Y wave and P wave and S wave, and these are just for your information. The major ones are above three wave patterns. Well, personally, I like this P wave because it often appears on a chart. It's a squeezing flag pattern, and personally, I am good at identifying these reversing edges in actual trading. But these Y and S waves are relatively more difficult to find on a chart based on my own experience. Basically, on these Y and P and S waves, these patterns often appears as a consolidation chart pattern, and in that case, you trade along with the major trend. Like when the major trend is bullish, then you trade towards the bullish direction. Sometimes Y wave can be a reversal pattern, but especially P wave. When you see this pattern on the market, most likely the price breaks the line upwards when the major trend is bullish like this. So time theory is to know when the price could reverse. It shows the time when the reversal could happen on Henkabi, a day of change, and can be a reversal candle. And it works just like a ruler on the market, like I mentioned on my previous video on part 4. Like you measure each candles so that you calculate and expect the day or the candle of when the market can reverse. And in this wave theory, there are I wave, V wave, and N wave, right? So now let's combine these two theories together. Are you ready? When you combine the time theory and wave theory, for example, let's say there's a bullish market and you measure how long it took from the beginning to the end of the trend, and let's say you find it to be 26 days. If that's the case, then what might happen for the next 26 days in the future will be these patterns. Like from this day on the highest, it might further extend bullish momentum for the next 26 days, or it could reverse and come back to the original price in the next 26 days. That could be I-wave hypothesis. Or the market moved up for the past 26 days, and if the market moves with V-wave for the next 26 days, then it could go down once, but supported somewhere along the way. If there's a support line somewhere, the price will be supported, and eventually it goes up and renew the highest level. Or if it's going to be on N-wave for the next 26 days, then the price could go up, down, then go up and renew the higher price after 26 days. This is how you combine time theory and wave theory together. So look at the drawing at the bottom. One of the examples can be like this. The price keeps going down with one of the Kihon Suchi, 9, 17, 26, 33, things like that. And after that, the market goes up with the same number of days. Same number of candlesticks with N wave like this. Or another case might be the first price movement can be V wave, and the next wave pattern can be I wave like this, or it could be V wave like this, or N wave. Goes up, down, and up eventually. And the significance is it can happen with the same or similar day cycle, similar number of candlesticks before and after the wave. Look at the example at the bottom. First wave can be V, going down, supported, and go up to like just half price level. And in the next cycle, the price goes down again, but supported again and moves up eventually. And this chart pattern, right? It's a double bottom. So when you calculate the first half V and second half V, you might be able to find a certain time cycle. You might find a Taito Suchi there. Finally, when the market moves with N wave, and let's say the N wave was created for the first 9 days, then the second 9-day cycle can be either I wave or V wave or N wave. So as the example below, after you find N formation, then you might find the price goes down once, but supported somewhere along the way, and eventually goes up. And you can find V wave in that case, you see? So again, with the same time cycle, well, sometimes it can be a little different, like 1 or 2 candles, but with a similar number of candlesticks, the market moves with either I or V or N wave between the first cycle and the second cycle within the market, and it can continue 3, 4, 5 cycles with the same number of candlesticks. And this is how you combine time and wave theories together and actually analyze the chart this way. And remember, the number of candlesticks can be anything in Kihon Suchi, like 9 or 17 or 26, or it can be with any numbers of candles. But either way, the number of first half and the number of second half candles can be the same, similar, and it's called Taito Suchi, as I mentioned on the previous video, part 4. And let's step into price observation theory. Officially in Japanese, it's called Nehaba Kansokuron, and if I directly translate them, Ne is price, Haba is the width of or volatility range, and Kansoku means observation, and Ron means theory. So the direct translation would be price, width, or volatility range observation theory. But I think it's too long to say it every time, so I just call it price observation theory in English. But you know the idea from the original word, right? There is some width or volatility range involved on this theory. So what this means is simply you find 3 points and take those 3 numbers to calculate where the price can be extended in the future. You can call it as a target, or you can call it as a reverse point. And basically there are 4 types of calculations. Actually, there are some other variations to this, but basically, there are 4 types of calculations. The first one is called V calculation. Let me give you an example. Let's say the market started at point A and you have the position slightly above that point. You placed buy here. And as you watch the market, it went up to the point B, but it now came back down to the point C, and this is where you're at now. So you have some profit already, but now looking for where to take that profit. In that case, you can use these calculations to know the potential target. And you do it by taking the price A and B and C and calculate out the point D. So here we go. Let's look at V calculation first. The idea is very simple. Basically, you take the pips from B to C and you add it to the price of point B. So it's going to be twice the higher level from point C. So if B to C is 10 pips, then from C to D, it's going to be 20 pips. Alright? This is V calculation. Next, E calculation. This is, you take the pips from A to B, and regardless of how much the pullback will be, add that pips to the price of point B, and you get the price D. So if A to B is 20 pips, let's say, then from B to D, the market will be extended another 20 pips upwards. And this is called E calculation. And let me move on to N calculation. You take the pips from A to B, just like E calculation. You take the distance between A and B, and let's say the market pull back to the point C. Then you add that pips between A and B to the point C, so that the pips between A and B and the pips between C and D will be the same. And let me show you how you can memorize these calculations. V calculation will be like this. You see a little V here, and the target D is twice higher from the pullback to the point C. And E calculation will be like this. You see a letter E here, and N calculation is just like the movement of the market like this. And these pips will be the same. And moving on to NT calculation, this is a little tricky, so listen carefully. From point A, the price goes up to B and pull back to C, right? And you take the pips between C and A and add it onto C, so that the pips between C and A and the pips between C and the target D will be the same. And it will be the target based on this NT calculation. How you can remember this would be you draw N here and you draw T here. And so the distance between C and A and C and D will be the same, right? As you can see. And I just put each equations here right next to the names. So whether if it's the uptrend or downtrend, no matter what pairs you're looking at, you can simply put prices on each A, B, and C and apply those prices onto the equations and get expected target, D, according to each calculations. And I will also put each equations on the description below, so you can refer to them easily. Let me give you an example. If you are looking at US dollar JP yen and trying to calculate the target with V calculation, let's say, when you find the price of point A as 90 yen and point B as 95 yen, and let's say the market pulled back to 92.5 yen, which is going to be the point C. So if you apply this price on the equation of the V calculation above, it will be 95 plus 95 minus 92.5, and it gives you 97.5, right? That will be the price of target D according to this V calculation. And you can do the same with E and N and NT calculations and get each expected targets. You just take 3 numbers and punch them into equations and you get the targets on each calculations. And like I said, there are other variations like 2E calculation or 3E calculation. Simply you add the pips 2 times or 3 times to get the target D. Or another variation is called half price calculation, in which you take the price of V or E or N calculation and add them up and divide it by 2. But these are kind of applied versions, so I'm not going into details this time. I'm just introducing them just for your information. Alright, so now let's look at some real chart examples. This is a daily chart of Euro Yen, and between this day and this day, during this bearish momentum, first of all, the lows and highs were moving exactly in 9-day cycle, which is one of the Kihon Suchi numbers. And I put the yellow vertical lines on these, highs and lows. And the first half was bearish V wave, and the second half was I wave. Well, technically the closing price is up here, so technically it's also V wave, but if you look at the lowest price, it's I wave, right? And if you look at these prices, the target, the point D is calculated by V calculation. Like if you look at the price of each point, the point B is 121.298 yen, and point C is 122.337 yen. So 122.337 minus 121.298 equals 1.039. So it's about like 104 pips there. And if the price goes down 104 pips from point B, what price do you get? You take the price of B, right? 121.298 and minus 1.04, and you get 120.258. And if you look at the chart, it's almost the target, see? The market was bearish, so it might be a little tricky because you have to go backwards, but you see how I'm combining these 3 theories together. First, you look for where the market moves with the same intervals, like Kihon Suchi. Then when you find the time cycle pattern, you check the wave, whether it's I wave or V wave or N wave. Then you take the A and B and C prices and calculate where the price target could be. Now, of course, the market does not always move based on time and price observation theory, but when you find these patterns on a chart, it's worth to trade, based on the calculations. So the real life example will be, let me black out a part of a chart so that it looks more realistic. Alright, here we go. So imagine you are looking at a chart like this, and you are thinking it's been bearish, so you want to place sell somewhere, but you're not quite sure where exactly to place it, right? Then when you look at a chart, you see a V wave with 9-day interval. If you go 9-day backwards, it will be somewhere like here, so it's been V wave after the bullish I wave, right? And let's say you find double top or like head and shoulder pattern in lower time frame, like 1 hour or 15-minute time frame here on the wick pointing upwards. Then you're confident enough to place sell here, right? Then as you hold the position, the price starts to go down from the point C. However, you have a voice in your head saying, where should I take profit? Sometimes taking profit is more difficult than cutting loss because we are basically all greedy, and you always have a dilemma of when to take profit, because if you take it too early, the price might extend afterwards, but if the decision is too late, then the profit might turn into loss. So you have a dilemma of when to take that profit. And in that case, price observation theory could give you, the answer. Based on the prices of A and B and point C, do the calculation, calculate each V and E and N and NT calculations and get 4 different targets. Then you take profit as you look at the actual price action in the market. This is actually how you can initially calculate the target. Again, you take the point A and B and C, then calculate the price of the target. And sometimes the target can be the same level as support or resistance lines, or it could be touching the channel line, Then you have, more information that backs up the target. And you can trade with confidence that way because remember, this is not a holy grail. So don't forget to combine with the lines and other indicators that you can rely on. Alright, so let's look at another example. This is a daily chart of Euro Pound, and again, from the point A, it went up to the point B, went downwards, then reached to the target D. So again, if you take the price A and B and C, and this time I will just give you the answer. If you calculate the target with N calculation, it's going to be the price level of D. So in this case, N calculation was the right answer. But again, this is obvious because you already know, or you've already seen the market, right? In a live chart, you might be looking at a chart like this, and maybe you place a buy here, or let's do this. Let's say you're not having any positions this time and looking for somewhere to reverse. Then first you find the market is being on a 10-day cycle. So you can imagine that in the next 3 days or so, the market will reach to some kind of remarkable price level, right? Then you start to calculate with those 4 calculations and mark those prices beforehand so that you know when the price is likely to be reversed, along with lines and other indicators, or perhaps based on some economic news at that time. Then as time goes by, the price finally resisted by point D, which was calculated by the N calculation this time. Then you place sell here and get all these pips. So these calculations are not telling that it will reach to that price level, but it can work as an aim, as a potential target, so that it gives you another clarification of what to do next. So again, time theory suggests a day or a candle when the price could mark the highest or the lowest, henkabi, and it can be one of the Kihon Suchi numbers. And these numbers are like a ruler to measure the potential market cycle. And based on the time theory and wave theory, suggests to create 3 types of waves within a certain time period. Like it could be a bearish I wave with 9 candles, or it could be, a bullish V wave with 26 candles, things like that. And the point is, these I or V or N waves are linked with these time cycles. And within the market, same number of days or similar number of candles appear oftentimes. And based on this time and wave, you can calculate the expected price target with V, E, N, and NT calculations. That it can be your target, or it can be a timing, for your reversal trades, contrarian trades. And remember to combine it with lines, chart formations, or Fibonacci lines, or anything, so that it gives you more information for your confident trades, right? And finally, analyze the market with Ichimoku indicator to integrate all the theories. Like, look at this chart. This is the same Euro JP daily chart with Ichimoku indicator on it this time. And look where I was explaining earlier here. And look how the price was resisted by Tenkan-sen and Kijun-sen, and they just did crossed and the price kept going down. And the price has been below Kumo, so it shows the market has been bearish in the long term, and the green Chikou span is below the candles, that it's also suggesting the market is bearish. and you find the market has been moving by 9-day cycle here, and so you place sell here, right? And based on the price calculation, you take the profit here. Or you could have been holding the position until the price hit the blue Kijun-sen, but either way, this is a typical way to trade when you combine Ichimoku indicator with 3 theories, because the indicator is meant to be created to put all these theories together, and they actually link together like this. Actually, I found similar patterns like this a lot in different pairs with different time frames as I prepare for this recording, so I want you to actually look at the charts and find them so that you can apply the real Ichimoku strategies as you keep on trading. First, look for the time cycles. Look for the Taito Suchi, where the same time cycle appears on the market, and identify the wave. And after that, you could look at the indicator to know the market situation, whether it's on a trend, how strong it is, where the equilibrium point can be in the future, where the Senko span 2 is located, Kijun-sen is located, whether the current candlestick is within the Kumo or not, things like that. Then calculate the price target or the possible reverse point with 4 calculations that I introduced today, so that you know exactly which day the market will be reaching to what price level. And I will continue to share my findings on YouTube or on Facebook or Instagram at times, so if you can follow them, it'll be great too. Alright, that's it for the video, and that's the end of Ichimoku series. I was recording 5 videos total, including this one, and from the history of how it's being created and the philosophy of the original inventor to the meaning of 5 lines and the 3 theories and everything. And ever since I uploaded the first video, I've been getting lots of emails and messages from traders around the world and showing their gratitude. So thank you everyone for being so supportive. My YouTube followers became over 500 members now, so I really thank you for your support. It really keeps me going, and I will keep creating more valuable videos and articles for Forex lessons. I will put the links on each video from part 1 to part 4 of this whole Ichimoku series on the description below. So if you haven't watched them yet, just feel free to watch them and give me your feedback on the comment box below. Alright, if you like this video today, please press a good button and please subscribe and hit the bell so that you get automatic notification when I upload a new educational Forex video or when I do live Forex analysis. Alright, see you on the next one. Stay gold. またね。